Remember, you're in these deals or anything that you're doing right now, you're always betting on the jockey, not the horse. And you have to have a strong network in order to see the opportunities that we see to be able to get into that.
Welcome to the Wealth Strategy Secrets of the Ultra Wealthy podcast, where we help entrepreneurs like you exponentially build wealth through passive income to live a life of freedom and prosperity. Are you tired of paying too much in taxes, gambling your future on the stock market, and want to learn about hidden strategies for making your money work for you? And now your host, Dave Wolcott, serial entrepreneur and author of the best-selling book, The Holistic Wealth Strategy.
How's it going, everyone? And welcome to today's show on Wealth Strategy Secrets. We have a special guest for you today, Salvatore Buscemi. Salvatore is the co-founder and managing partner of Brahmin Partners. He has over 2 decades of successful wealth management expertise that spans various asset classes, including real estate and venture capital. And his latest book, Investing Legacy, unveils the investment decisions of the world's wealthiest families. Hope you enjoy the show. Sal, welcome to the show.
Dave, it's a pleasure and a privilege. Thank you for having me.
Yeah, 100%. Really looking forward to the discussion today, Sal. And, you know, what's so exciting is your latest book that you've put out that I think is going to be really fascinating to our audience today to really learn how, you know, the top 0.1 investors are really, you know, investing their wealth, mitigating their risk, how they see wealth, right, and define wealth, right, in terms of building a legacy. And I think that can be often elusive for many, right? And in a lot of cases, it's kind of opaque on purpose. So, you know, one of the purposes of our show is to try to help investors kind of demystify some of these things, you know, get these, you know, important learning lessons that the best of the best have really uncovered. So look forward to diving into your book today, Sal. But before we get started, you know, if people aren't familiar with you, let's kind of, you know, jump into where it all started for you.
You know, it started when I was pre-med in college and I was working for a surgeon who was championing me. And this is on the Upper East Side of Manhattan. And he had a beautiful apartment with a beautiful wife and an Aston Martin. And he told me the future, this is back in 96, 95, was in plastics. And he's right. If you fast forward today, that's where it was. But the problem is the summer during my internship between junior and senior college, I passed out holding a fibula in the cadaver room. And then after that, I was involved in another sort of circumstance where I was working with another doctor. And I just really was not, the sight of blood in large quantities really wasn't something that I could really deal with. And at this point, I had invested a lot of money. My parents were fortunate enough to pay for my college education and my brothers as well. And I was thinking to myself, did I just waste 4 years studying biology and chemistry for nothing? And I had to talk to the surgeon who I was interning for at the time at Beth Israel Hospital, which are now condos over on the Upper East Side of Manhattan. And really the punchline, and I'll tell you, is, you know, that's fine. I understand that, Sal. You're a great person, a hard worker. By the way, I want you to meet my brother. He just made partner at Goldman Sachs. And then the rest is history at that point. And what you learn is that you learn a lot more about the relationship of people, especially as it relates to money, but also how trust is built on relationships today. And if you fast forward today to where we are, we're in a very transactional relationship today. Money's been very easy. The crypto, you know, crowd came out and they were, you know, creeping into your direct messages and emails selling you crypto. But really the way we work and the way a lot of families work are, you know, that interactivity is the new currency today. And we're always on top of our families, taking care of them, investing on their behalf. We're a glorified investment manager. You know, we're a multi-family office. And we've invested in companies that have 2 rules. Number 1, no first-time founders. This isn't Shark Tank. We only invest in founders that have had pedigreed and have had exits before. Number 2, I like to make sure that there's other investors who are smarter than I am on the cap table. The cap table to me is the soul of the asset. And what we've been able to do is we've been able to build a formidable portfolio, not just in real estate, but also in earlier stage ventures such as technology and life sciences, using those 2 rules. And it's really steered us out of trouble, especially since the Silicon Valley Bank debacle and so forth. I have had 2 institutional real estate funds that have been very successful. And actually, just recently, I released my letter to real estate investors that I'd love to give a copy to your listeners too, if they want, where we go over the successes that we've had and the reasons for those successes.
Yeah. Okay. Excellent. So tell us a little bit about your business model then. Are you primarily running a multifamily office? What does it look like?
Yeah, we're primarily I spend my day to day spending about 50% of my time talking to new investors and current investors. We have 13 families that we invest on behalf of, and that takes a lot of time. That's 13 different kids that I never had, if that makes sense. And then when you pile in the CEOs, that's another 15 companies that we have. So I have about 31 kids right now. That I I don't have any kids,
Yeah.
natural kids myself, but it takes the same amount of time being on top of them, being responsive and catering to their demands and their needs, not necessarily the investors, but also making sure that I'm communicating to the investors where things are. They like to know that, especially older investors. The second gen today has a different mentality. They like to look at the money first before looking at where it comes from. They have a different sort of, understanding or expectations about how things work. For us, it's been great because we've had a great track record, and that allows us to be able to raise capital whenever we need to into certain companies. And if you have a good reputation and a good track record in this industry, you're invited to do things that many people aren't, and that's invest alongside some of the world famous companies and bring in new investors into some of your startups that you might not have been able to get into before. And we've been invited to invest into things like SpaceX. We're in the middle of that right now. We've invested in Stripe. We're going into Neuralink. So there's some of the more household names, but there are some other household names that you might not have heard of, but you'll hear of soon, such as Thrive Bioscience. And that's an example of a founder that's had 18 exits, and Thrive Bioscience will be his 8th exit. And that's what we concentrate on, is quality. I spend a lot of my time just putting people at bay. There's a lot more sell side, what we call people selling their deals, than there are people with capital, it seems like today. So we spend a lot of our time making sure that we organically grow our deal flow so that we're not looking at it from broker dealers or anyone else. We're very, very curated, and it's based off of our reputations of myself and my partner in the industry.
And do you have a particular focus on certain sectors or asset classes?
Yeah, we do not like consumer discretionary. So anything that you see on Shark Tank is something we would never invest into, something that's usually knocked off by a kid in a garage or someone in China. We don't want to deal with that. We like higher barrier to entry businesses that have the chance for outsized returns, but also leave an incredible amount of legitimacy as it relates to just the performance and the impact that these companies will have. For example, we have a company in our portfolio called Envive Solutions. Envive Solutions has democratized the artificial defibrillation device. And for the first time in 30 years, it's democratized. People will have it in their purse. And they were the youngest team ever to get FDA approval for this artificial defibrillation device. They sell for about $1,000 a piece, but they've been selling very, very quickly, mostly in fleet accounts such as fire, EMT, schools, universities, churches, and so forth. And because unfortunately it's become the norm rather than the exception for athletes to collapse on the field, any mother, anyone with one of these in their pocketbook or on their hip pocket are going to be able to provide some life saving. What's the word I'm looking for? It will be able to perhaps save the life or extend the life of someone who might not have been able to get medical help, in that
Sure.
short period of time. That leaves a legacy, and we get to see how many times that thing's been used. And so we gauge from the CEO that, if it's pulled 1,000 times, it's almost saved 1,000 lives. So a lot of my investors like to hear that. That will have an outsized return at some point later on. They're going into a different financing round right now that we're participating in, and we're very happy with that because again, you're working with best in class people, with best in class investors, and that for us gives us the certainty that we need to make sure that we'll have an exit at some point in the future, rather than hoping that someone will figure it out.
Right. And how have you been able to really map the alignment of, your family's investor mandates with, your focus on, where you're looking for opportunities?
It depends on the family. If it's an older established family, and again, a family office to me is someone with $100 million north of investable assets. They usually have their own mandates. Some of them who are around between the 50 to 100, they don't know what's going on. They usually just have a liquidity event, and they're trying to figure it out themselves. And we provide the guidance for them to be able to do that by showing what the bigger people are doing and why they're doing it. And I think if you see the leadership in numbers, then people really start to take notice of it. They're not going to be listening. These are not the same people who are going to be listening to Dave Ramsey or Susie Orman, right? These are not the same people who are going to be listening to basic financial advice. They want to get into the same asset classes, whether it's life sciences, whether it's Class A industrial real estate, than their older brother, than their older brothers and sisters are doing, or richer brothers and sisters are doing. Great example of this is the person that owns Zara the brand. He buys $1.3 billion worth of real estate free and clear. He only buys what we call statement class real estate, and so do we. Because our investors are already wealthy, Dave. They're not looking to get rich quick by investing in a multifamily conversion in Columbus, Ohio. They're looking to get into something where they can brag to their friends that they own it, and they have credit quality tenants that they know are richer than they are.
Yeah, and more of a concentration on wealth preservation at that point as well.
Correct,
versus
yes.
growth, right? Mm-hmm. Yeah. Yeah, interesting. And so are you seeing any particular trends right now? We're just entering Q2 2024. So many things going on, right? Geopolitically, around the world, the dollar, I mean, all of these types of things. Have you seen any particular trends that you're either A, trying to avoid, or B, where you're seeing opportunities?
We're seeing a lot of opportunity right now in distressed real estate. And I said that's my pedigree in the whole situation, is that we're looking at these opportunities. And when we look at these deals, we're not buying them ourselves. What we're doing is that we're investing in the GPs or sponsors that have done this before. And the secret to success is this. There's 3 rules. Number 1, any GP worth their salt, I want them to have at least been through at least 2 cycles. This cycle is not even started yet. 2008 was a cycle. When I started working at Goldman Sachs in the late 90s, that's, another cycle when we started to see interest rates rise commensurately as sharply as they have today. The second one is I want to see audited financials. And third, I want to see a meaningful co-invest. Okay. For one of our deals, the family office that we worked with that developed the industrial building, they put in 50%, we put in 50%, and it's overperforming right now. We like that. So really, if you have the belt and suspenders on, like we have, then you're able to take advantage of a lot more opportunities. We're very agnostic as it relates to it, only that we wanted to make sure that our families want statement quality assets. If it's a hotel in Miami Beach that's in distress, but there's a family coming and they're going to put it under a new flag and they have a proven model of doing that, we want to get involved in it. If it's a development of an industrial property in Tampa, at the Port of Tampa, actually, which is one of these opportunities we're looking for, which is a Class C to Class A conversion, that's something we're going to be looking at. If it's maybe an office building in New York, which we're also looking at, where it's a good, deep, discounted basis, we're ready for that, as long as we don't violate from the belt, suspenders, and life jacket that I told you about, the 3 rules. As it relates to other things, you're starting to see a lot of families move into getting very well companies at discounted prices, especially as direct private investments that continue to go on. No more people who get, these outsized valuations in venture. Things are coming in pretty well and pretty steady. A lot of the families, too, that we work with, they prefer to go direct rather than working in funds. Funds to them is a 4-letter word because they see fund managers, name whoever it is, making a lot of money off of fees for the funds, but not necessarily showing performance. If you have $1 billion under management, 2% is 20 million a year off the top of my head. And that buys a nice, portfolio of artwork per year, but it doesn't really incentivize your investors. So we have gone out of our way, and I talk about this in my 3rd book, making sure that we have an alignment of interest and asymmetrically structured to do that to the benefit of our investors. Our investors come first and foremost. There's always going to be other deals out there, but we are very, very thankful for the CEOs that we have because they've really shepherded us through some very tight times, and of course the profitability too, which we've seen recently with one of our deals, actually just the fintech company that just got acquired by Sumitomo Life. The name of the company was Sing Life, and so our investors got a nice return on that. And what are they doing? They're putting it into industrial real estate or some in kind.
Yeah, no, I think you're really spot on with that. And that's really one of the missions of this show, is to really try to raise financial literacy for people, because I think wherever you were raised or brought up, right, I think we were all surrounded by this Wall Street mentality, and stocks, bonds, mutual funds is really the only way to invest. And when you really break down that model and you understand how it works, over 90% of it is an AUM model. Right. So all they're trying to do is just get more assets under management, more investors, and, they're just milking everyone from that. And even when the market goes down, they're still making their fees. Right. Which is why, one of the reasons that really led me into the private space, right, because it is much more of a performance driven model. Mm-hmm. So are there any other things or, let's say lessons that you could share with investors of reasons why to avoid, Wall Street, or to look at, some of these other asset classes or private, right?
That is, you're either rich or you're not. And the people who gravitate, and the pandemic really sort of exacerbated this, I think, and that is a lot of the people who were coming into, and I was writing my book at this time, who were going into meme stocks. These are mostly men who are trying to legitimize themselves by getting rich quick. So they're trying to, with all the conviction, they're telling you about an ICO, some sort of cryptocurrency, or maybe a meme stock, or they're asking about it. But they don't really understand that they don't really have the long term in mind. A lot of the women investors, and that's, a lot of the people who make decisions today and hold the purse strings, honestly, are women. They have much more of a longer term focus. They're more focused on legacy and impact too, to a certain degree, as long as they can understand it and it matches their profile for impact. Not everybody wants to, for example, plant 1 billion trees, right? There's other initiatives that people would rather be a part of, and our investments provide that. And the other thing too is that when you look at the mainstream financial advice, nobody ever really got rich off of that, right? I mean, it's we're starting to see that right now, where people have barely been able to retire, but if you have all your money into common stocks, which can be wiped out in a bankruptcy at any given point, right? Any company can go bankrupt and wipe out the equity. Then what do you really have, right? And I think a lot of people have not really understood that. They look at everything as far as the gross terms, that everything grows, but they're forgetting that over that term, a lot of companies drop out. A lot of them lose their valuation. They lose their listings. And you got to be really understanding. It's like, am I really looking to create wealth or keep wealth, or am I looking to get rich quick? And the middle class, unfortunately, is looking to get rich quick. And that's why you've had, over the past 20 years, people like Jim Cramer come on and actually, turn buy and hold into a WWE match, right? I mean, that's really what it is. It's he's out there making people day trading and, racking up lots of fees for Schwab and for all the other brokerages out there, but rarely does it ever help any of the listeners or the viewers of those shows. So people who do have a lot of wealth, they need to understand, what are the richer people doing? And they're not just going into just say like real estate, they're also buying sports teams. We're looking at buying fractional shares. And I'm going to say fractional shares. We're looking at buying smaller ownership stakes and some professional stakes right now, because there is going to be a lot of wealth transfer right now happening between the boomers and, what we call the next gens, the second gens, who will be accumulating that wealth too.
What if everything you thought you knew about investing was wrong? Would you like to create a wealth strategy like the top 1% have and get exclusive access to top private equity deals that provide downside protection, tax efficiency, predictable cash flow, and have a lucrative upside? Discover how with the Pantheon Advantage and join our investor club today at pantheoninvest.com.
So, Sal, we had Michael Sonnenfeld on from Tiger 21 a few months ago, and we were talking about portfolio allocation strategies. Mm-hmm. Have you developed a particular investment thesis or portfolio allocation strategy that you typically see or advise for your families?
Yes and no. I think it's a function of their own risk. I think when you look into portfolio allocation, it brings out negative normative connotations of like an 80-20 bond portfolio, right? And that's sort of been blown out of the water now that rates have gone up and things have sort of turned upside down. All the wealthy families I know, when they get into it, they're looking to preserve that, and they want to get into the safest, but also the nicest real estate they can get into. So about 50 to 70% of their portfolio is put into what we call statement class real estate. And I can show you examples of that, what that looks like. That could be a building in New York City. You can read the real deal, the real deal, and on realdeal.com, that sort of goes over all the trades that are happening in the real estate market. But they're all gravitating towards those larger asset classes, because to them that's seen as a store of wealth. They don't know that, but that's what we tell them to do, and that's what we direct them into. If the world ends, there's always going to be needs for industrial. People are always going to be buying from Amazon, for example. Industrial is always going to consider to be one of, I think, the strongest asset classes, even though I think it's been bid up a little bit. Again, that's just real estate, not just industrial. The rest is usually in cash, and then about 20% of it goes into venture. And that's what we manage but not venture funds, more private direct investments where the investors have implicit direction and control over the investment. For example, in 2006 or 2003, when Martha Stewart went to jail, if you owned her stock, you're not going to get her on the phone, right? Investors like the fact that, either I or they can call the CEO and ask questions at any given time. And that's really what they're gravitating towards, is the discretion of having a direct private investment. We're direct private investors, if that makes sense.
Yeah, for sure. And how about from a tax strategy standpoint, right? I mean, is that one of the alluring aspects of investing in real estate, right? So they can have that kind of, circuitous motion, right? That's always driving that tax efficiency, the income,
Of
and
course.
forced appreciation.
I mean, America is still a great place for people, wealthy people, to invest worldwide, and it always will be. And I think if every real estate agent knew that, they would be looking for buyers overseas to invest in areas in Miami and Southern California and New York. There's always going to be the tax advantage, but that's not necessarily the only reason why people go into it. There's a lot of people that went into real estate and lost their shirts, but they thought they were getting tax advantages. Of course, there's always going to be the 1031 exchange. Hopefully that'll continue to go on. And I don't really see that being legislated away anytime soon. But they're looking more for this. At first, they're looking for the safety in the investment and durability of the investment and the duration of the investment rather than looking for the tax advantages, because that just comes automatically. You have to
Yeah.
choose your investments wisely.
Yeah. So are you personally, Sal, are you co-investing in these types of opportunities?
Oh,
Is
yes,
that
we
your
are.
strategy as well?
Yeah, we are. I mean, just building this family office cost probably close to about $500,000 just in legal fees. And then this has been the result of people following me after leaving Goldman Sachs, going into some of the riskier things, into life sciences and technology and other types of opportunities that are more considered to be venture. And once you build a track record with that and people see you investing alongside, then they continue to build on. We do that in our deals because we do have exits that we do appreciate. And so we naturally reinvest our money. It's not like we're taking the proceeds from, say, Sing Life from like a week ago and putting it into like Tesla stock. That's not really what we're doing. We're looking to put it into other places, and that provides the leadership for other families to follow in. They'll say, Sal's going into this one deal. We want to go into it. Here's why you should look at it.
Yeah, makes sense.
Leadership
So,
of the checkbook,
Sal,
Dave, is what we call it.
oh, I like that. Yeah, that's great. So let's unpack your book a little bit.
Sure.
Investing Legacy. What inspired you to write the book, and can you highlight a couple of the big lessons learned?
I had been asked during the pandemic, I got very bored, and I was also dealing with the loss of my mother at that point. So I needed something to do. And I had rented a house out in the Hamptons for a week with some friends. And I was kicking around the idea of writing the book. And then finally, I called my publisher, and I went with a female publisher, Andrea Albright, Beverly Hills Publishing. And the reason is because 70% of all book buyers are women. And a lot of the conversations I've had have been with women, especially when it comes to money. The reason for that is because, as I said before, they're looking for things that are much more durational focused. They're looking for legitimacy. They're looking for not just legitimacy, but also legacy, whereas their male counterparts are looking for legitimacy, trying to get quick, rich fast, trying to be the next Stevie Cohen, trying to be the next, Ken Griffin, whatever suits you from that standpoint. But the allure of not having fast money was something that a lot of people resonated to. And it was really sort of like an eye-opening account, because it was a recollection of conversations that I've had with people over years saying, what is this guy doing? I just inherited this much money. What is this big rich guy? I want to invest like he does. I want to be able to, why do people invest in sports teams? Answering all these questions in the book. And I was able to get it done, actually. And I wrote it, and after I wrote the first version, I actually ripped it up because I wasn't really happy with it. It sounded too textbooky. And what I did was I started soliciting people, because at the time everybody was calling me, telling me they were sorry for my loss. And I said, hey, by the way, now that I have you on the phone, former Goldman Sachs partner boss, I'm writing a book and I'd like to quote you in it. And I've been able to amass a lot of people to sort of legitimize a lot of the crazy things that I would say on there, like why people don't invest in crypto and the type of people who invest in crowdfunding type of things, more like the lower the barrier entry things that everybody avoids. And I actually sit on the board of a company called Genius Biotechnology, which is in Boston. I sit on the board with Stephen Rockefeller. I was able to get him in the book too as well. And it really sort of brings to the picture of what the wealthy are really investing into. And it is not the same thing as what the middle class are investing into. They're investing into name brand statement class assets run by people who have had many, many exits, or real estate sponsors or GPs or owner operators, landlords who have been through many cycles, and they've seen this before, and they know how to navigate it, and they have the maturity, but also the network to be able to get themselves out of trouble, and they're not overpaying for things as well. And that sort of implicit safety is the reason why I wrote the book, because there's been a tremendous amount of wealth creation happening, especially since the pandemic, where money is basically a commodity today. Everybody's got it, but not everybody knows where to put it. Sort of like having a gym membership. Everybody has a gym membership at some point, but that doesn't necessarily mean you know how to get into shape. And that's why we put the book together sort of as a community handbook, where not only do I have my coworkers in the book and past and present, in the book to sort of show the narration and give a story. But in order to impress upon people, this is how the real world works when you're dealing with the top 1,000th of the 1% of the wealthy people in the world.
Yeah, outstanding. And what would you say, I mean, given all of your experience as well as working for all these families, you know, and that relationship capital that you have, how would you actually define wealth?
Wealth to me is 100 million or plus in investable assets.
Okay. And anything beyond that, right, in terms of social capital, like, you know, anything from more of a holistic perspective?
Oh, from the holistic standpoint, I mean, it's your character.
Yeah.
At the end of the day, it's your character. I would not be able to be where I am today if I didn't have a good reputation and a character. I mean, that's really what it is. What these very wealthy families are looking for, if you're from a wealthy family, say from Texas or something, they're looking for being around people who are like them. This is the greatest, and I write about it in the book, but the single greatest networking opportunity that I've ever been in has been with a bunch of professional sports team owners. There's no other society like it on earth. It's like YPO on steroids. These are people who are at the top of their game, and they are, you know, looking to be with other people who are who are in kind like them. And there's, you know, some sort of like an implicit mentorship too as well, where you see some people bringing them up the ladder and things as it relates to that, and introducing them to investments that they're in. But that's really, you know, when it comes down to it, it's the networking that's the most important today. We live in a world today, Dave, where there's a loneliness pandemic, I feel. And that happens especially, and it's even more acute with the wealthier people. And if you're able to put together, you know, social situations where people can benefit off of that, then it's going to be a lot more fun. You don't get that from your, you know, Raymond James banker, for example. But if you know the guy that owns part of, say, the Dallas Cowboys, then, you know, that might be someone who you want to, you know, network with to figure out why he's doing it. And pretty soon you'll be like, you know, some of these sports owners that own parts of many teams, right? And there's all sorts of stories about that all over the press with Wexingham and some other, you know, some other teams that are owned by some famous people. That's the networking. They're getting into it for the legitimacy, but also for the legitimacy of the network that they're in. Anybody can have a tremendous amount of followers, but to have a real core group of people to help you is something that is very hard to find today.
100%. How about from a personal perspective in terms of productivity, self-improvement? What's your best morning routine or productivity hack that you could share?
That's a very good question. I like to wake up and go to the gym in the morning. And what I do is when I'm on the treadmill, if I finish the podcast that I want to listen to on my financial podcast, I will immediately go in and start dictating emails and just sending to myself to write later, to send out to either our investors or to other people, and just networking with people. I get bored easily. You know, there's only so much music I can listen to sometimes. So I like to, you know, listen to stuff, but I use that time sometimes just to be interacting with people. Sometimes I'll just go to the treadmill here in my apartment in Miami at around 8 o'clock at night. And I know that some people are, you know, in California. I haven't really reached out to them for a while, and I'll just put half an hour aside on the treadmill and talk to them. To do that, it's a stacking of activity for me. It's an excuse also for me to go out there and do that. Another thing too, which is great, is there's technology which keeps everybody together. And since moving to Miami, there's been a bunch of people who we're from New York and Boston, and I put together a WhatsApp group called, you know, 305 Intelligentsia, for example. And we meet, you know, for coffee or, you know, pizza or some sort of social setting. Or if I'm going to a conference, there's many conferences going on this week in Miami, for example, I'll always, you know, do that. It's the interactivity, which is the new currency today, and the attention, which is the most important. It's not really so much of a productivity hack. It's a hack of making sure how are you in front of people who are important and meaningful to you, and that you're meaningful to them.
Yeah, right. Because relationships are so important, and, you know, working on those connections. Yet oftentimes I think we can be, you know, distracted and pulled in so many different directions in our day unless you're really intentional about it. So I love how that you've created some really, you know, parameters and a system around, you know, making that effective.
Yeah.
What do you think in terms of if you could give just one piece of advice to the audience about how they could actually accelerate their own wealth trajectory? what would it be?
I would say you need to start networking, and I would get out of your comfort zone. I think the hardest time it is with people today is that they tend to stay siloed with people who they feel safe with. A common example of this would be doctors. Doctors take financial advice from doctors who they appear to be more successful than they are, but it's usually into stocks and crypto or some other liquid security that's more speculative. But if you really go and you really want to start growing if you really want to start growing your prominence and you really are thinking about your legacy, then it might behoove you to start being involved in certain organizations and clubs where you actually might have to travel a few hours to go somewhere to meet with other people who are just like you. In Miami, New York, San Francisco, still, I mean, especially in Miami where I am, there's always sort of family office conferences that are always going on here. Just ask someone, feel free to reach out to me. I can, definitely guide you there, but you need to get involved in the ecosystem in order to keep yourself interested. Number one, you don't want to get discouraged earlier on. And a lot of people get discouraged because they make an investment in something and it was really, investing in their brother-in-law who's an alcoholic, his company, and it didn't go anywhere. And then they say venture's too risky. Remember, you're in these deals or anything that you're doing right now, you're always betting on the jockey, not the horse. And you have to have a strong network in order to see the opportunities that we see to be able to get into that. And the people who are really serious about that need to learn how to network with people who are actually investors, not necessarily sell-side advisors, if that makes sense.
Yeah. 100%. Sal, really appreciate your time today. This has been really insightful.
Thank you, Dave.
And look forward to digging into your book some more.
Thank you.
And if people want to, connect with you, check out your book, what's the best place?
They can go to investinglegacy.com to download a free Audible code of it that I've opened up just for your listeners. It's free, so they get an Audible code from Amazon, which is great. I narrated it myself. I was told by someone I respect named Mel Robbins to narrate my third book myself. I did. A lot of people like listening to it. I heard it has great iambic pentameter. So it's been cynically reviewed and people enjoy it. But you can go to investinglegacy.com, and also you'll be onboarded onto our multifamily office newsletter, so you can see all the stuff that we're doing and sort of look under the teepee.
Yeah, no, that's awesome. But yeah, I give you a lot of credit for doing that, because being in the studio for a couple of days to record your own book is it's quite a job there. So that's excellent. And we will make sure to put all those links into the show notes so people can find that as well. And really want to thank you again, Sal. Been really insightful, and look forward to staying connected in the future.
Thank you, Dave. The pleasure's mine. Thank you.
Thanks for listening to this episode of Wealth Strategy Secrets. If you'd like to get a free copy of the book, go to holisticwealthstrategy.com. That's holisticwealthstrategy.com. If you'd like to learn more about upcoming opportunities at Pantheon, please visit pantheoninvest.com. That's pantheoninvest.com.